Silver is the market's tripwire, and when it twitches, gold usually hears it next. Most people watch gold for the headline, but silver often writes the first draft before the crowd shows up. If you have ever seen silver jump and wondered why gold lags, this is the hidden chain reaction. It starts with a simple truth most charts hide. Silver is both money and a raw material. That split personality makes silver react to the world faster, like a sensor with a thinner shell. Gold is a fortress asset, but silver is a busy intersection where many motives collide. When a new shock hits, the intersection clogs first, and price becomes the traffic report. Silver's market is smaller, so a modest wave of demand can look like a sudden tide. Small markets move on marginal orders, and silver lives on the margin more than gold does. That means the first push often comes from traders who need speed, not long speeches. Industrial buyers do not wait for a narrative to mature. They buy when costs threaten margins. Factories feel supply strain early because their input contracts renew faster than investors rebalance. Solar, electronics, and medical uses create steady baseline demand that can turn urgent overnight. When supply looks tight, manufacturers hedge, and hedging is quiet buying with no headlines. That buying hits futures first, because futures are where you can move size without moving trucks. Futures flows matter because they set the reference price for everything that follows. Once futures lift, dealers mark up coins and bars, and retail sees a price that feels alive. Retail is momentum sensitive, so a small spark can turn into a sudden rush to catch up. Now the chain reaction speeds up because silver volatility attracts short-term strategies. Volatility targeting funds increase exposure when trends strengthen, and silver trends strengthen quickly. Options amplify this, because market makers hedge options by buying when price rises. That hedging can create a feedback loop where a move pulls more fuel into itself. Silver's thinner liquidity makes that loop louder, so the move looks dramatic on screen. Gold usually does not move as violently at first because its pool of liquidity is deeper, but gold is listening, because gold trades as a macro verdict, not a micro scramble. Silver provides the early signal, and gold waits for confirmation that the signal is real. Confirmation often comes from rates, because precious metals compete with cash yields. When real yields soften, the opportunity cost of holding metals falls, and gold wakes up. Silver may move on supply tension or growth hopes, but gold waits for the policy shadow. So the bridge between them is expectations: inflation, growth, and central bank credibility. Here's the part few people connect. Silver's industrial role can move inflation expectations. If manufacturers pay more for inputs, they protect margins by raising prices where they can. That passes through to the data investors watch, and gold responds to that slower drumbeat. Silver moves first through the cost pipeline, then gold moves when the pipeline hits finance. Another hidden link is collateral, because metals markets lean on financing and trust. In stress, lenders widen haircuts and traders reduce positions in anything that can gap. Silver can gap, so it gets cut first, and that selling can be violent and short-lived. Then, when panic fades, bargain hunters step in, and the rebound looks like a new story. Gold's response comes after, because institutions rotate when the macro picture clarifies. Think of silver as the front end of a whip, and gold as the handle held by bigger hands. A small flick at the tip is visible first, and the handle moves when the force travels back. This also explains why silver sometimes fakes you out with sharp moves that never reach gold. A silver spike can be driven by a single pocket of demand, like a supply bottleneck or a hedge wave. If that pocket resolves, silver cools and gold never needed to react to a temporary squeeze. But when silver holds gains, it is telling you the pressure is broader than a single trade. Watch the structure, not the excitement. Is the move sustained across days and dips? When dips get bought fast, it shows real demand, and that demand tends to recruit gold. Recruitment happens through relative value traders watching the gold to silver relationship. When silver outperforms, some funds buy gold as a calmer proxy and sell risk elsewhere. Gold becomes the portfolio hedge, while silver becomes the high beta expression of the theme. That pairing is common during reflation stories, where growth and inflation rise together. Silver cheers the growth part, gold guards against the inflation and policy mistake part. When the theme is fear rather than growth, the order can flip, and gold may lead instead. But in many cycles, silver still twitches first because it is more sensitive to liquidity shifts. Liquidity is the oxygen of markets, and silver feels oxygen changes before gold does. That is why headlines about a single factory, mine, or ETF can jolt silver more than gold. Supply matters too, because silver production is often a byproduct of other mining, which limits quick response. Byproduct supply cannot ramp quickly just because silver price is screaming, because miners chase other metals first. So when demand surges, the market cannot answer fast, and price becomes the rationing tool. Gold supply is different, with deep above-ground stocks and a mature recycling stream. That stockpile dampens shocks, so gold can wait while silver has to shout without losing its reserve aura. Now add geopolitics, where sanctions and trade friction disrupt supply chains and expose weak links in sourcing. Those disruptions hit industrial metals first, and silver sits right on that border. When trade lanes snarl, procurement teams react, and silver catches the shock early. Then macro investors connect the dots to inflation and currency risk, and gold joins. Even the media plays a role because silver's percentage moves attract attention, and attention can recruit new money. Attention creates belief, belief creates flow, and flow can turn a chart into a story. Gold prefers quiet conviction, but it follows when the story becomes a thesis embraced by cautious institutions. Here is how to use this without getting trapped by noise. Look for the trigger source. Was it industrial demand, a future squeeze, a currency swing, or a sudden rate shift? If the trigger is rates and credibility, gold is more likely to confirm the move because policy sets its tempo. If the trigger is a narrow supply squeeze, treat silver as a storm that can pass quickly. Also, watch how other assets behave because metals are part of a larger risk mosaic. When equities rally and yields fall, silver can sprint and gold can glide after it. When equities fall and stress rises, gold may lead and silver may hesitate, then catch up. The key is understanding that silver is a messenger with a loud voice and a fast heartbeat. Gold is the judge that speaks later after it weighs the evidence and the cost of cash. So when you see silver move, ask what it is detecting that gold will care about next. Is it supply strain, liquidity shift, inflation pulse, or a change in trust itself? That question turns a random spike into a readable signal and a disciplined plan instead of a reaction. Look at the plumbing signals: rising lease rates, tight vault inventories, and stubborn retail premiums. Paper can move faster than metal, so wide spreads between futures and physical often warn of stress. When mints fall behind and delivery times stretch, silver can surge, even if macro news stays calm. If open interest climbs while price rises, it can mean fresh buyers, not just shorts running away. But if the move fades as positioning unwinds, silver may have spoken too loudly for the moment. Gold tends to respond when those signals align with softer policy, weaker currency, or broader risk. That is, when the chain reaction completes, and the early silver move becomes a full market message. Silver moves first because it is fragile and useful, and fragility reacts before certainty. Gold moves next because it is trusted and patience reacts after proof. And when both move together, you're not watching a trade, you're watching a regime change.